Talk about mixed emotions. Holy moly. Scary first half of the week, not so scary in the second half. You're watching the Daily Stock Market Brief. This is the weekly recap episode, so we're going to get into a little bit more detail on specific charts. Because I'm out on vacation, we're going to be doing things a little bit differently. I'm going to have timestamps in the description below. We're going to be going through the indices, indicators, starting with the indicators. Then we'll go into commodities, the dollar, and then the 10-year. Then I'll tie it kind of all together with a conclusion as to what I'm looking for heading into next week. With that said, no intro today other than what I just said there. So let's just hop right into commodities. Commodities. First off, you probably have noticed certain commodities have been taking a little bit of a nosedive. Iron ore was down around 10%. Lumber, you can see here, has been getting hit as of recently. Now, is this a full-on reversal taking place? It's too early to tell. This could be just a breath consolidation potentially before it finds its legs and heads higher or consolidates more sideways. As of right now, we got to pay attention to what is taking place with lumber because this is a very important piece in a lot of senses. Now, if I pull up the lumber to gold ratio, this is from Michael Guyad's white paper, you can see the rate of change really took a nosedive from 80 down to 40 here. When it goes below zero, that is a risk-off environment, so we're still quite far away from it. However, if we start seeing things like gold continue to play out quite well, so gold held itself up, and various precious metals did too as well, versus various other commodities. So it's going to be important to kind of see how this broad basket of commodities, which we'll look at the CRB, lumber, and how they play in comparison to, for example, gold and silver. So gold is at a very important key place right here. We're below that 200-day daily moving average, and we're in confluence with an area of resistance. It's been holding up quite well so far. Every time it's gotten there, we've seen some pretty significant sell-offs. So let's see here what takes place. I am seeing strength in the miners. That is a very good sign. So we might be looking into some various miner plays here coming into the weeks ahead. Now, when I look at gold on the weekly time frame, I can draw this out a couple of ways. It looks like it's breaking out right here. But if I were to draw this line up a little bit, then it'd be a little bit of a different story. So I kept it like this just because it's a good looking channel. We broke out. That looks pretty good. Price percent oscillator did cross over. That's bullish. It is below zero. And we're sitting there with a little bit of a hanging man candle on the weekly time frame. That's a little bit of a concern, but nothing too much to worry about if we don't get any continuation to the downside or anything like that. So we need confirmation. Other than that, we're sitting right at the 50 weekly moving average and the confluence of resistance of 38.2. You layer that on with this confluence of resistance right here and the 200 daily moving average. The price of gold has some work to do. There's a lot of confluence of resistance right in there. Silver, from a weekly perspective, still trending sideways. We saw some strength in the previous week. Now we're just kind of seeing it take a little bit of a breather here. Still below a main area of resistance. From another perspective, we're above the 20-day EMA and the 50-day EMA. So that's nice as of right now, but we're still really just channeling here. Price percent oscillator looks like it wants to cross over here. That's a bullish crossover above zero. That's a good sign for the price of silver, so we'll continue to monitor that. Crude oil, slightly up on the week, a little bit of a hanging man candle at this area of resistance. Let's see if we can get this continuation, get above this really 67.50 range right here. It's kind of it's a zone, resistance here, resistance here, resistance here, and we're trying to get above it as of right now. That'd be really good for various energy stocks. But keep in mind, since we're not there quite yet, let's see how the next week plays out, because this could, if it heads down lower, it could bring down energy stocks with it. Now, energy on Friday, I believe, was the top performer, so it saw a lot of strength. So that, from a daily perspective, crude oil as well saw some strength too. So we'll continue to monitor this, but it was very scary looking week. But the bulls did step right back up to create this kind of long lower wick you see there. The CRB index, you can see, I mean, this thing has just been skyrocketing vertical, very overextended. It's time for this thing to take a little bit of a breather at some point. This week, it did take a little bit of a breather, down 1.7%, $3.67, as you can see here. So nothing crazy, right? It was very bullish. We came up to around 210. It was 209.50, and then we reversed on the week. I would like to see this take a little bit of a breather before it starts to head higher. We're kind of in this area of resistance, but we did see that 2-year breakout. So commodities, overall, the basket, the CRB index, looks good. It's just very overextended, which means, okay, let's see if now we're going to continue to see various other commodities take a little bit of a breather. And then maybe we might continue to see gold and silver perform, which would be very interesting for that lumber to gold ratio going into a potentially risk-off environment. As it stands right now, like I said, we are risk-on. Bitcoin, we called this little trend line out right here, and it broke down. It was looking very weak. It still is kind of looking weak here. It's just a period of distribution. You can see the slowing momentum on the price percent oscillator, as well as the RSI, these lower highs, and you kind of see it arcing here. We need to start seeing strength here, or it's going to start breaking down to 40,000, maybe even into the 30s. I would say 40,000 would be that first marker. The 200-day moving average lines up pretty well with this previous area of resistance. We broke through it, and then there's an area of support right kind of in this zone. So if it falls, it can fall pretty fast right into that area. As it stands right now, we're holding up a little bit of a double bottom right here, right at around, where is it at? Close. 48,000 is kind of that zone right there. So we'll see if we can get some strength here. But as it stands now, this could be potentially flagging. You have this little pull right here, and now it's kind of just consolidating sideways right now. So we'll continue to monitor and see how this one wants to play out. Let's hop into the indices right now, starting with the S&P 500. Now, if you remember on my monthly recap, last monthly recap, we talked about these three bars that looked very similar here as they went above the upper Bollinger Band, and then it takes a breather. Well, we got above it. We saw the weakness. We didn't even reconnect with the 5 EMA. The month isn't over, but as it stands right now, if we head higher, this will be a little bit of a hanging man candle right there, which could set us up, back above the upper Bollinger Band again, which would be more of a, sell on strength type of environment. So we'll monitor this, but just take note that we did not actually reconnect with the 5 EMA, which would have brought us right around 4,000. That was the zone that I was really keen in on there too. From the weekly perspective, we didn't have any trend break, but you can see here it was one big red candle, and then the bulls stepped it right back up. I will say, seeing this, it's a hanging man type candle, but none of the trends, none of the tactical or technical levels actually really broke. So we just saw a big expansion in volatility, a large range candle, a lot of movement, but nothing really broke as of right now. So we'll just watch that. Daily time frame, look at, we took a 4.4% correction, if you even want to call that, in 2 days, and it was so scary, right? Just bing, bing, bing. And then on the last market brief we were talking about, okay, panic usually brings opportunity, and we're getting overextended readings. Now, this is where it becomes very important, is when we have sharp sell-offs but very quick rebounds, these can potentially be dead cat bounces. So you got to be aware that sometimes you just get this strength that comes in, and then it sells back off. That's a possibility, but it has to be confirmed. As it stands right now, we closed at 41.73. We probably got to get back above 4,200, a close above there, 4,200 to 4,250, to say, okay, that's no longer a dead cat bounce. This could have just been just a temporary, shakeout moment before heading to more even all-time highs. But you can see it pulled down into the 50-day moving average, and the buy the dip crowd step right in very quickly. So nothing technically broken there. And now from a 30-minute perspective on the VIX, this is why I say it's important to look at these key levels. You can see we came up in here, and as we've been talking about, this is the area where you'd want to go long. As we came up here, a little surpassed it. That's totally fine. That was right around where we pulled into the 50-day moving average, and then that would have been that buying opportunity. As it stands now, we filled one of the gaps below us. We left this one back above us, and we still have two more below us, as the VIX is kind of getting this oversold reading, which indicates to me if we get very oversold here, that could be very well an area where we start to see an increased volatility spike. Doesn't mean that it has to be big, but just to reset that level there. From a weekly perspective on the VIX, you can see here it was a big vol spike, and right up to the upper Bollinger Band and this upper trend line right here. As soon as it hit right around 27.50, slightly higher, 29, just call it 29 right here, intra-week, the bears here stepped right back in, or the bulls on the S&P 500. So this spike just says, okay, there was a lot of fear early in the week, and then it subsided. So we'll see here. We'll continue to monitor this and look for these key levels, because if we do see any specific gaps on, for example, the 30-minute time frame, and you see it pulling into certain areas, it could give you a good heads up to either go long or potentially short the market as well, depending on which levels you are kind of watching. Now let's hop into the Nasdaq. Nasdaq, look at where we pulled into. Right about the yearly open, we found support right there, as well as the EMA, the 20 EMA. You could see the bulls step right back in. We do see the Qs kind of getting weaker these last 4 weeks, small range candle, a little bit larger range, a little bit larger range. So it's picking momentum up to the downside, but the bulls keep buying back up that dip, staying above that EMA 20 EMA there. So a lot of volume coming in right at that little area of support. So this could potentially, it could very well bounce in or turn into something, but we do just got to pay attention to the momentum. It's still lagging right there. And then from a daily perspective on the Qs, I just redrew this out to look like a channel. You can see here just a lot of chop, a lot of potential distribution here. We have resistance here. It was overthrown here, and it was overthrown at this range too. So we're starting to see these potential, A, B, C type pattern. If I'm not really into Elliott wave, but you can see this 1, 2, 3, and this right here 1, 2, 3 type movement, which could result into a potential leg higher. You can see the price percent oscillator curling itself over. On the price action though, overall, this could also once again be a dead cat bounce. We saw strength in this day, and then it was followed through some red weakness. So we have to really just pay attention to the futures market and see where we open up. As it stands right now, though, if we recapture the 50 and the 20, it's going to be looking probably a little bit stronger for tech. We are right here at this area of previous resistance. Last time we broke out, we saw a nice big move higher, and we're kind of just getting right to that level. You can see the price action closed right on the 50-day moving average. So as it stands right now, this is more of a holding period because from a relative standpoint, tech has been, the laggard. And we'll get into the 10-year yield here too soon, which is an important piece to all of that. Semiconductors make up a big portion of the Nasdaq composite. The semiconductors closed below the EMA 20. All right, that's the first time that's happened on a weekly basis for a very long time. You can see dating back to around, it closed here, April-ish, mid-April of 2020, so almost a year. And now, we're right here around May, and you could see 1, 2, 3, 4, 5, 6 candles, just 6 red candles, seeing some big time weakness here, and we had a lot of volume step in here too. So you got to be very careful with this because these could help make the Nasdaq composite really suffer or fail to make new highs if we start to see semiconductors continue to weaken as well as tech. Now let's look at the Dow Jones weekly perspective. We tagged that resistance darn near perfectly, overbought readings, large range candle. You can see just a lot of volatility back and forth, but the bulls did step right back up. Nothing technically broken here at this particular point in time on this specific technical pattern that we're watching. And then the price percent oscillator looks like it's about to do a bearish crossover, but we still need confirmation on that as well. Transports, hanging man candle, dragonfly doji potentially, or just a doji graves. There's so many different names to this stuff. Just note that that's a pretty bearish looking type topping candle as we're moving into a very overextended area. Why is it bearish? Well, you can see here the bears really show their strength intra-week. The bulls did pick back up, so you need confirmation to the downside on these type of moves. But just note that the bears did show up, so they are there. There's going to be supply. And if that supply is met with some follow through, you can see, or supply is met with a weakening of demand, you can really see an exhaustion of buyers and see the market kind of roll itself over. Still overall very bullish context, just very overextended levels. So we're right there at the upper Bollinger Band on a weekly perspective. Not the greatest looking candle, very overbought readings. This is not the place where you'd really want to go along the transports. I personally would not want to go along the transports there, but it would be something that you can consider selling on strength. So for example, if we get big gap up, you might see selling pressure occur during that. Now here's the Dow Jones on the daily time frame. We overall it's just still a very bullish. We had this reversal type candle. We had some follow through. Came right around to the 50-day moving average. We're now back above the 20-day. We're back above the 50. We're above the 100 and the 200. Everything's sloping up. Everything looks very strong right here. So until we see continued weakness, or if this does get confirmation of a dead cat bounce, this is still a very, very bullish looking market. Now let's look at the Russell. Russell tells a little bit different of a story. The thing that we were eyeing on was that 5 EMA from a monthly perspective. Check it, tagged it, bulls stepped right back in, bought that dip. From a weekly perspective, these long lower wicks don't look the greatest. All right, it's just showing that the bears keep stepping up, but people keep buying that dip. But we're not seeing any continued strength from that. You can see here we did crack this trend line. We did recover the 20-period moving average, which is good for the bulls, but it darn near gave it away intra-week. So just be careful on this one particularly. We need to start seeing some strength come in very soon, or this is just a straight, it's going to look very obvious if we start breaking down. It'll look like clear distribution as the bears and selling pressure comes in. You can see those long lower wicks, and then, we get to buy the dippers. Now, from a daily perspective, it pulled right into that neckline, which matched with the 5-monthly EMA, made for a good trade from the long perspective. So if you got that, congratulations. Overall, though, we're still not out of the woods. This could be an advanced head and shoulders or complex head and shoulders pattern. We're below the 20-day, we're below the 50-day, and you can see that they're crossing over. It's a death cross of sorts. Death cross, not the 50 under the 200, but the 20 back under the 50, and it's done that now a few times, which to me that means the trend is kind of slowing down, and this could be, you don't know if this is a distribution phase or if we're just accumulating, consolidating, potentially another leg higher. But as it stands right now, below the 20 on the daily, below the 50, and it's still within this kind of structure here. So continue to monitor and see how that one plays out. Let's look at the DAX. DAX from a weekly perspective, I'm showing this because first off, the correlation between European markets and US is pretty spot on. If you were to compare, like, for example, from Asian markets, you'll see the correlation is not nearly as good. So it's important to look, at France, for example, or even German DAX to really see kind of, what's taking place. And this is just like the perfect dragonfly doji candle. That is a dragonfly doji candle. You can see it's like it opened, saw a lot of weakness, bull step back in. It's still within this period consolidation, overall in bullish context, but that is a topping type candle to be aware of. You need confirmation. Nothing's been confirmed, so don't put too much weight on it. You can see here from the daily perspective, everything is still in very bullish context. Price percent oscillator looks like it wants to start picking back momentum. You can see these last 2 days of trading, boom, boom, came to the 50-day moving average, cleared it right back above the 20, but we're still within this kind of just choppy consolidation. You can see there's resistance here. We came back tested it once, back tested it twice, and we've been just chopping back and forth here. So very similar to the U.S. markets. Not much going on. It's just a period of potentially distribution, or it's a period of just consolidation to see that next leg higher. Maybe we have some big players accumulated even more. It's very hard to determine at this particular point in time. Now let's look at some indicators. First off, indicators. We're looking at the NIAD on the daily time frame. I like looking at this intraday and then also daily just for overextended readings. I wish I would have brought this one up. I didn't catch it just because I'm still here on vacation. But when you get these oversold readings like minus 2,500, it typically is a short-term bottom, and it tagged that short-term bottom perfectly, and we see some strength. Now what's crazy to me is not only do we see that strength, but now look at the reading up here. Now that's an overbought reading, which is a very high reading, and we haven't been there for quite some time, which means to me, okay, maybe perhaps that this could be a dead cat bounce, because we saw this weakness, oversold, and then we immediately got very, very overbought readings here. Nothing's been confirmed. I like looking at this for more of finding a short-term bottom, but you can definitely use this as finding these overextended readings to both sides. Just note that is a very overextended reading. From a sentiment perspective, the asset managers really took a nosedive here. We haven't been this low for quite some time. You can see they took their foot off the pedal. Will this continue into next week? I don't know. Hanging man candle here on the S&P 500. You can see that right here, and you can just see that drop off. You can see the right X though. Right X hardly budged, barely. It was still pretty darn bullish in my opinion. It's a little bit more bearish comparatively to previous weeks, but still overall pretty bullish. The big change there was in the drop in the asset managers from a reading of above 80 to where is that reading? Below 50, 46. From a another sentiment point of view, the II bulls and bears, and then also the ratio down here. We've been calling that negative divergence. Now we're seeing a little bit more the ratio head a little bit lower, and you can see that for the last 5 or 6 weeks here, you can see sentiment has been slowly going from very bullish to just a little bit more bearish here, but still nothing too dramatic. The Cohan high-low, I like to find bottoms with this one. Last time it was down, we called this level out, which was a short-term bottom where we saw that bounce, and now we're coming back into that level. you can use that as a gauge, because when we look at this, okay, for example, and pair it with the BP NDX, you can see here that there's a positive divergence, which means to me there's more room for the BP or the NDX to go up higher, which says, okay, maybe tech has room to run here, maybe semiconductors, or just the Nasdaq in itself, the Qs. So there's room to go up here, and then you match that in with the Cohan high low, and where's the Cohan high low? You can see here it's pulling into that previous area where we found support there before too. So you have that hammer candle there on the weekly time frame. You're pulling into these areas of support. You're getting some oversold readings with positive divergences. That's why I've been saying, okay, it doesn't mean necessarily that it's going to happen, but there's a lot of ideals in the favor to kind of lean towards tech or the Qs when you're trying to hedge long or find long positions, because it seems to me like there is still opportunity there at this particular point in time. From a breadth perspective, we're looking at the NIMO, the Nasdaq-McClellan Oscillator. We saw that very overextended reading, broke down through that little trend, minus 60. That's a pretty overextended reading. You pair that with something like this that fell this low on that specific day, it says to me, okay, we'll probably see that bounce. And we got a couple of day bounce. Now it's kind of the pieces are kind of coming together. We match that in with the 30-minute time frames, right? On last week, or the last episode that I did, where we saw some positive divergence in the price action of the various indices, and we're starting to see that bounce. So something to note here is during bear markets, which this isn't a bear market, but even the start of bear markets, the bull rallies are very strong. You'll see very aggressive moves that'll trick a lot of people, and then they'll head back down. That doesn't mean that this is what's happening here. I don't actually personally think that that's what's happening here. I'm prepared for if it was to happen. I don't think that that's the case. So what we need to make sure that we're paying attention to is really what's happening with the commodities. We're seeing various commodities take these big dips. We're starting to see strength in gold, right, and silver as of right now. And those are more fear. And then from a relative perspective too, we're starting to see XLP and XLU, which are more of a risk-off type environment. We're starting to see those continue to improve from a relative standpoint too as well. But overall, the last day of trading, -7, as we saw the market kind of ramp up higher. Pretty low reading there. Nothing too crazy to write home about. BP SPX, not quite oversold or overbought. You can see here we're printing at -38. If it gets into this oversold reading, that says to me, okay, we have some room to potentially bounce up, but we're not quite there yet, which means to me that we have room to go down and we have room to go up. All right, that is almost all of it. Let's go into the dollar. So this is interesting to me. So the dollar saw some weakness. Let's actually look at the daily time frame. Dollar saw the weakness, strength here, obviously, in the S&P 500. So, and on various other commodities like gold, for example, and silver. When you see the dollar go down, you can sometimes see strength in those. But we've been seeing this correlation. We've been tracking it with the S&P 500. When it started heading lower, you saw we broke out of that 4,000 range. We came back into that 4,000 range as we saw some strength there. And now we're seeing it kind of just chop back and forth. Now, from a seasonality perspective, the US dollar in May does typically pretty well. It's not doing well. However, from a technical perspective on the year, we're still positive on the year. All right, so it's still up on the year. This gray dashed line is where the year opened, and you can see we pulled down in there. We saw some strength. Now we're starting to see some weakness back down into it. So right now it's just consolidating. Until it breaks down through there, that I would say, okay, that's more bearish. And if we do continue to break down through it, that could be very, very bullish for various other assets. Like we could continue to see the market just rip up and melt up higher here. So we're going to continue to watch that development. What's interesting to me, though, from a weekly perspective, this needs to be confirmed. Okay, we had the price percent oscillator crossing over. That could be bearish, right? Below zero, so that's pretty bearish. But the previous candle on the weekly time frame, it is an inverted hammer candle, pulling down to the downside. That is actually a bullish type reversal candle. You can have both a hammer candle on the downside, which we saw something like that, but you can also see inverted hammer candles, because what it's doing is psychologically the same thing. It's showing that the bulls did show strength on this down movement, then all of a sudden they appeared. So we need to see continuation and follow through, but that to me shows that, hey, there are bulls down here that have pressed it up higher. So it needs to be confirmed. Hasn't been confirmed, but just note that if we do start seeing strength there, that could put more pressure on the equity markets there. 10-year. We started breaking out of this flag, and then it reverted. The week was mixed signals, right? We saw the weak economic reports, which pushed the 10-year. Obviously, started ripping higher on the higher than expected CPI. We started moving higher, and then we reverted back down to just slightly up. So nothing really changed with the 10-year. Now, if we see this continue to see strength, if it's just finding its legs to decide where the bond market wants to move next, and if it starts ripping higher, I would imagine that we're going to continue to see weakness in technology. That would make sense to me. But as I see it at this particular point in time, a little bit of an inverted candle. If it starts heading a little bit lower, we might see that strength come in until we refind our legs and potentially head higher here. We're yet to see. Now, if we do start breaking out, pay attention to financials. The financials typically do much better in an environment where we see the yield go up. Why? Well, as the yield goes up, that creates more margin for the banks, to borrow short-term, lend long-term. All right, so let's wrap this all up with a conclusion. I'm a little bit all over the place today. That's only because I'm out here in New York City still. What am I going to be looking at for next week? Really, because of this week was so mixed across the board, there's a few things that you should all be really kind of focusing on. One, if we're going to continue to see this weakness in commodities, various commodities, but we're starting to see this strength in gold and silver. So I really want to pay attention to gold and silver going into next week, because that can be a really good setup for various miners. But I need to see gold break above those levels that we were talking about. For example, from the daily time frame, we need to get above this resistance in this 200-day moving average. From the weekly perspective, we need to get above the 38.2 retracement level, which that means let's see gold get back above 1850 and hold there. That would give me a lot more confidence going into various miners and such. From a other perspective, as far as the indices go, I'm going to be just very tactical. So I'm going to be paying very close attention to the 30-minute time frames, and then most likely the hour, 30-minute time, the 30 minutes and the 15-minute time frames too as well. So I'll be posting those probably via Twitter and or on my Patreon group, which I will be posting some trade ideas in Patreon here coming very soon, probably a little bit later today. So be on the lookout for that if you're part of that group. That's all I got for you on today's episode, everybody. See you later.